Hello, everybody. Welcome to today's Centre for Policy Studies webinar. My name's Tom Clockerty. I'm Head of Tax and Editorial Director at the CPS, and I'll be chairing our discussion over the next hour. It's a fascinating and very timely topic we've got for you today, namely the Bank of England. Are we better off after 25 years of independence? I spent a short period of my career working primarily on monetary policy, and unsurprisingly, I have views of my own, but I'll keep them to myself for the time being because we've assembled a truly expert panel that I'm excited to hear from. We're going to have David Smith, who has been economics editor of the Sunday Times since 1989. It's always nice to be able to give a one-line introduction like that. We have Anne Siebert, who is a professor of economics at Birkbeck and I believe Columbia in New York, and a well-known monetary policy expert. And we have Gerard Lyons, who is chief economic strategist at NetWealth, and also a former advisor to Boris Johnson when he was mayor of London. The format is fairly straightforward. We're going to have about 5 minutes of introductory remarks from each of our panelists. David, Anne, and then Gerard, the order in which I introduced them. And then we'll have some discussion among the panel before handing over to you, the audience, for your questions, which if you could please submit using the Q&A function in Zoom, that would be much appreciated. Thank you. So I think without further ado, let's hand over to David Smith. And David, are we better off after 25 years of Bank of England independence?
Thanks, Tom. Well, the short answer to that question is yes. I think we are better off. I think if we're better off in economic terms, but we probably would have been anyway. So GDP per capita, however you measure it, is higher than it was 25 years ago, but it probably would have been anyway. But if you look at the despite the clear inflation overshoot that we've got at the moment, which is the most dramatic in those 25 years, as we all know. Average inflation measured by CPI over the 25 years is pretty close to 2%, almost exactly 2%, I think. And not many people would have expected that for an inflation-prone economy like the UK when Bank of England independence was announced. I mean, quite a lot has changed over that period. I mean, you will remember in the run-up to independence that the great fear was that interest rates were very political in the UK, and that particularly because of the importance of the mortgage market. But of course, the mortgage market has changed. Vast majority of mortgages now are fixed rates, so there isn't the same kind of immediate sensitivity that comes with interest rate changes. Now, I think you see a bit of that now, in the sense that the bank obviously has been, can be criticised for the tardiness of its response to the current inflation overshoot, and criticised, as I would criticise it, for persisting with QE right through 2021 when it was clear that we were going to get a big inflation overshoot. But I think if interest rates were still in political hands, if they were still decided by the Chancellor, I find it difficult to see that you would have even seen the kind of response on interest rates that we've seen in recent months from the bank. In other words, one of the political responses to the cost of living crisis would have probably been to not raise interest rates, I think, which would have added to the pressure. So I think it's good that monetary policy decisions are out of the hands of politicians. Long may that continue. As I say, there are criticisms of the bank's tardiness in response to the current inflation surge, but also I would say, the period of independence you can almost divide into two halves. I mean, the first half leading up to the financial crisis, I think that was a period where there was a genuine and interesting debate among members of the bank's Monetary Policy Committee, EU, and it was a period in which I think the bank was prepared to use interest rate changes. Obviously, we hadn't seen QE then, interest rate changes more flexibly, and not to mind too much reversing. So 1 month they might be raising interest rates, a couple of months later they could reduce them, and I don't think any reputation was lost by doing that. Since the financial crisis, I think there has been the debate on the MPC has been much more constrained. The willingness to use the tools at its disposal, particularly interest rate changes, have been limited. So there were periods between the financial crisis and the pandemic where rates could and should have been raised, but weren't. So we went into this later crisis with rates already very low and the monetary ammunition therefore restricted. I also have some doubts about the bank's overriding economic approach, which is essentially looking at the output gap, the spare capacity in the economy, to judge the extent of inflationary pressures. I think as we're seeing at the moment, when a lot of those pressures are coming from external factors, that approach has its limitations. And I think we're seeing that. It's almost as though the bank adopts a closed economy approach to monetary policy. And I think that needs to be looked at. If as I hope, independence is to survive the current political difficulties, then I think the bank needs to think about how it approaches monetary policy in a slightly different way than has been the norm, certainly in recent years. But we are better off as a result of independence. It's something I think that we was always thought to be difficult for the UK to do. It was done, and I'm glad it was done, despite, as I say, the current problem is the current overshoot. I'll stop there and hand on. Yeah, thank you.
Yeah, David, thank you so much. I've made a number of notes there of interesting themes to pick up on. So thank you for kicking us off so brilliantly. Anne, let's go over to you.
Massively expansionary monetary and fiscal policy combined with adverse supply shocks and central banks that failed to act quickly led to soaring inflation in the late 1970s and early 1980s. The policy response was a revolution in central banking aimed at shielding monetary policymakers from political influence and mandating the pursuit of low and stable inflation. An example of this was the Bank of England Act, Gordon Brown's signature project and a remarkable achievement. However, the devil was in the details. The chancellor could arbitrarily set and change both the measure and target level of inflation. He could seize control of monetary policy in exigent circumstances. He could suggest that a failure to meet the target was acceptable or would even be viewed favorably. In short, the act never protected the MPC from political influence to the extent that it might have. Monetary policy functioned reasonably well until the onset of the Great Financial Crisis. Then researchers and policymakers rediscovered the financial stability role of the central bank, and the inflation mandate seemed a mere distraction. Inflation rose to over 5% before falling to zero. Worrying about it came to seem out of step. Following a massive monetary and fiscal stimulus and adverse supply shocks, inflation rose to 7% in March. The latest response of the MPC has been a timorous 25 basis points increase of its policy bank rate to 1%. It has also cautiously announced that it would consider beginning the process of selling UK government bonds held in the asset purchase facility. Meanwhile, real interest rates are starkly negative. The labor market continues to tighten, and the MPC expects inflation to be at 10% by Q4. There is no obvious reason to think that the adverse supply shocks will diminish anytime soon, and they may well worsen. The MPC's belief that if they delicately pussyfoot the bank rate to 2.5% by mid-2023, inflation will plummet to just over target within 2 years seems like magical thinking. The MPC should remind itself of the costs of inflation, the menu costs, shoe leather costs, relative price distortions, and bad interactions with the tax code. They might also consider what an unfair and cruel tax inflation is. The brunt of the burden is typically borne by the poor and the unsophisticated. With no agricultural produce or fertilizer from Ukraine Food price inflation may be far higher than 10% by the end of the year. Politicians attempting to exert influence over the MPC might remind themselves how visible and disliked inflation is. So, are we better off? Well, it all depends. The MPC faces a choice. It can announce that it will enact a sequence of 50 basis points increases in the bank rate to whatever level it takes to bring down inflation. And this is likely over 6%. And it can sell off the asset purchase facility bonds. Yes, this is going to upset financial markets. Yes, this is going to temporarily lower economic growth. Alternatively, it could tiptoe along, watching inflation rise and persist. Inflationary expectations will become entrenched, and there will be even greater pain when inflation is finally brought down. The Bank of England states on its webpage, "We set monetary policy to keep inflation low and stable." Maybe they should.
And thank you. Well, that really is food for thought. Okay, Gerard, I think we've got lots to come back to in the discussion.
Thank you. Well, first and foremost, it's a great pleasure to be here, and thank you for inviting me. I'd like to focus on three areas: lessons from the beginning when the bank was given operational independence, second, the performance, and third, some lessons for the future. If we go back to 1997, it was a political shock when the Bank of England was given independence, but it was not an economic surprise because it had been the centre of economic debate for the preceding 5 years. And some of the issues that were debated then in economic terms are still relevant now. Now, back in the mid-90s, the worry about the bank being made independent was that there would not be enough accountability, there would not be enough transparency, and there might be overkill in monetary policy terms. Many of those issues were addressed in the format, but not all of them, particularly the accountability. It was accepted that making the bank independent would send a clear signal influencing inflation expectations and inflation volatility, keeping inflation volatility low, and that's been proved correct. But some of the issues raised then are still relevant. Did we actually need it? Interestingly, prior to the bank being made independent, there was a very good paper in the Bank of England's quarterly bulletin by Barrow, the economist, who looked at 67 countries and found that independence, and at that time many countries were independent in terms of their central bank, independence did not guarantee low inflation. Institutionalizing an independent central bank was no harbinger of low inflation to come. In fact, often it was a third factor, something outside a central bank or indeed a country's control. And indeed, that's been the story of the last 25 years. China's entry into the World Trade Organization in 2001 has probably had more of an impact on low inflation and achieving it than making a central bank independent. Another issue addressed in 97 was, is this really the issue that we need to address? Britain's poor economic performance, many people thought then, was because of the overburdening importance of the Treasury. And the Treasury, let's remember, through the Chancellor chooses the governor, the Treasury chooses all the members of the committees, the Treasury basically has clear line of sight over the bank still. And also back in 97, if we were to make the bank independent, what target should we choose? Eventually, we went for a 2.5% inflation target, then a 2%, but a nominal GDP target was talked about then, but was ruled out by many people because of the lack of accuracy and frequency of GDP data. Now, of course, as we've seen this morning, we have monthly GDP figures. So there are lessons from 97. But if we come to the performance over the last 25 years, we have achieved relatively low inflation. It's averaged 2%. So that's a good tick. But causality and correlation are key issues. We likely would have had low inflation even if the bank had not been independent. China's entry, as I mentioned, into the WTO, subsequent globalization, the squeezing of the share of wages in the share of nominal income, all of these have been key drivers. So I agree with both Anne and David that we need to look at pre-2008 and post-2008. Post-2008, there have been three cardinal sins exerted by the Bank of England. One, they have contributed and fed rampant asset price inflation. That has had wider negative economic and social economic implications. Obviously, it's not the only factor contributing to rampant house price and asset price inflation, but it has been a key factor. Second, the Bank of England has, in my view, not really guaranteed financial market stability. Its monetary policy actions, in fact, maybe have questioned whether we actually have seen the bank contribute to instability in financial markets. Low policy rates mean markets have not priced properly for risk. And as David touched on, quantitative easing has distorted the whole shape of the yield curve in the sense that the biggest buyer of government debt in the last 18 months has been a non-commercial buyer, the Bank of England. And on top of that, the Bank of England completely misread inflation last year. So much so that two wrongs do not make a right. They were wrong not to tighten policy last year. And indeed, if they had not been independent, I'm sure, contrary to what David might have suggested, we might well have seen rates go up last year. But the second wrong is not having tightened last year, that they now seem keen to tighten when the economy is unable to cope. But just to conclude the second part, other issues we haven't really looked at and don't really figure enough in the debate is the relationship between monetary policy, microprudential and macroprudential policy, MIP, MAP and MOP, and the whole focus on the other committees of the bank that not only determine financial stability, but also prudential regulations. And the other point is that a couple of years ago, the bank commissioned a really, really good report on the future of finance. But in their reply to it, they pointed out that there was a gap of £22 billion in the funding of small, medium-sized firms in the country. The fact that they could actually say that and not one senior executive at the bank thought that that was an important issue to address raises questions. Third and finally, and very briefly, lessons for the future. Communication has become centre stage, and indeed David's colleague in the Sunday Times at the weekend, Oliver Shah, talked about the poor communication, not only with the markets, but with the public and the private sector more generally. Communication is key. And indeed, prior to the independence of the bank, we had had pretty good effective communication. So that's an issue, and maybe it's about individuals, not about the process. Scrutiny. In the early days, there was good scrutiny of the bank, largely through the Peston Committee in the House of Lords. The only real scrutiny we've had, apart from people like David in the press, was the Forsyth Committee in the House of Lords last year, questioning QE. Should not Whitehall and Westminster be questioning more the actions of the bank? And the wider role of the bank in the society needs to be reassessed. And I think there needs to be a reassessment of the Bank of England's remit. I think we need to move for an inflation target. I would advocate a nominal GDP target. Indeed, in the months before he became governor, Mark Carney talked about having a nominal GDP target, but he talked about having a nominal level GDP target so we could have some historical dependency. I wouldn't actually argue for a level. I would argue, as the great Sam Britton used to write about in the 1990s, about a nominal GDP target, maybe 4 to 5%. And I think that's relevant for where we are in the economic cycle now. Set so that you don't have rampant inflation, but also set at a level or a rate rather, where there could be fast enough to generate domestic demand. And also it would be consistent in monetary and fiscal policy terms with allowing the ratio to GDP to come down. So to conclude, there are still lessons from 1997. The performance over the last 25 years, yes, we have had low inflation, but I agree with David, we need to look at the pre-2008 and post-2008 period, and lots of issues, I think, are left hanging. And when we look at the future, it's not just about personalities, it's also about processes, and it's about policies that we enact. And there is long overdue need for a remit reassessment at the Bank of England.
Gerard, thank you very much. I'm really pleased, actually, and this underlines, I think, how fascinating a topic monetary policy always is to discuss, that we simultaneously, between our three panelists, have agreement on some big questions and disagreement on other very big questions. And I wonder if now we could explore those two things. So I think that an item of agreement that I detect in what all of you have said is that the Bank of England misread inflation last year, that they carried on with an easy monetary policy with abundant quantitative easing. long past the point where it was appropriate and where perhaps it should have been clear that inflation was going to take hold. And is that a sort of an accurate summary of your view? Oh, I think you're on mute, Anne. Sorry.
Sorry.
You're good now.
Okay. Yes, that's an entirely accurate reading of my view.
Okay.
And
And
they felt that factors were transitory long after it was clear that they were not going to be transitory.
what in your view should have tipped them off? What was the sort of the red flag moment that, you know, people on the MPC should have said, we need to change course now?
Well, once the economy started to recover, there was really no point in having the what did you call it, guys? Called the asset purchase facility, and that should have been run down. And when inflation started rising, they should have started increasing their policy rates.
Yeah. Okay. And I guess that brings us though to the point of disagreement between our panelists, because I think when we consider the question, what now, as opposed to what mistakes have been made. And I think you're very clearly of the view that monetary policy needs to go further and faster in terms of unwinding QE and interest rates rising. David, it sounded like you thought that they were doing it about right, given the circumstances. And then Gerard, I think you said that two wrongs don't make a right, and that actually tightening now could be quite counterproductive. So I wonder if we could explore that point of disagreement. I mean, Gerard, maybe the question to you is what you think the Bank of England ought to do now, accepting perhaps that none of us would start from here.
Okay, well, thank you. Can I answer this in two parts?
Yep.
One, the context of last year, because I still think that's relevant, and what next in direct answer to your question. A year ago, the question that I asked at Net Wealth, and indeed I'm on the board of Bank in China, I was asking it there as well. Which is it? Is inflation going to pass through quickly? Is it going to persist, or is it going to become permanent? Now, the Bank of England thought it would pass through quickly, and that seemed very risky in my view. It seemed wrong, and it clearly has been wrong. I agreed with them and the other central banks that inflation picking up would not become permanent. But as we know from the past, once you let inflation out of the bag, even then you can't be certain about that. But global pressures are still there, technological change, financialization, many of the factors that contributed to low inflation in the past are still important. But what it was clearly evident a year ago, or what was clearly evident rather a year ago, is that inflation looks set to persist. At the very least, the Bank of England should have stopped QE, and they should have started to raise rates as emergency levels of rates were no longer required. It was quite clear the economy, as Anne touched on, was recovering, and inflation a year ago was 0.7%. Goodness. Was it going to any lower? Of course not. So they should have been tightening. What is remarkable is that all 9 members of the MPC agreed. Surely at least one of them needed to just raise the questions. Admittedly, by May, Andy Halding. What should we do now? Look, I think there's a number of issues here. R-star is the big issue in central bank terminology. When central bankers go to Jackson Hole, their annual gathering in Wyoming every August, 2-3 years ago, pre-pandemic, the issue was R-star, the neutral level of interest rates is close to zero and has converged globally. I think the issue in my now is that the direction of monetary policy clearly has to be for tightening, but it's the speed and the scale of the tightening that I've questioned. I think the central bank, the Bank of England, needs to pause for breath here. Eventually, we need to have higher R-star. Interest rates, when we're out of this crisis, need to settle at a higher level to start to have some sense of normality restored to the economy. But to actually move from here to there, the speed and the scale of the tightening has to be influenced by the conditions in front of you. Last year, the Bank of England, with a clear road in front of it, instead of going slower, put its foot on the accelerator. Now we're at the bottom of a very steep hill with the economy clearly in difficulty. The Bank of England is deciding to put its foot on the brake. It's not about the direction, it's about how you actually drive the car when you're going along the road.
Okay, thank you, David. Sorry, I don't know if I got a little bit of internet judder there with my connection, but So the question I wanted to put to you was about, why do you think this happened? What caused the Bank of England to get it wrong last year? And are those pressures that sort of caused them to make the wrong call then still prevailing now? Is this politics? Is it groupthink? Is it just that they have a very difficult job under testing circumstances?
Yeah, thanks, Tom. No, there is a lot. I think groupthink is a good way of describing some of what. But I think by the way, on QE and QT, quantitative tightening, I agree with Anne. I mean, and I've written this. I think that they should, rather than have said we'll come back to it in August if we consider active asset sales in August. They should have started to do that straight away in May, and rather than give bank staff time to think about it. I mean, it's clear that they were going to meet their own threshold for starting those active sales. I mean, as you know, the one version of QT, quantitative tightening, has already begun, in the sense of not reinvesting the proceeds of maturing gilts, and that was worth 28 billion off the total of QE in March. But I think they should have moved to that, and they should have moved that quite quickly. What happened last year was very curious, because the decision to proceed with quantitative tightening through 2021, quantitative easing, through 2021, was essentially the result of a decision made in November 2020. And November 2020, no vaccines had been administered in the world against COVID in November 2020. The first didn't come till December of that year in Coventry. We didn't know what the recovery was going to be from the pandemic. The economy at that stage was still in its second lockdown. So, but the bank said then, we will do, I think it was 150 billion of additional QE through the course of 2021, and not to recognize during the year, from about the spring onwards, that it would be sensible to pause that program or reduce that program. They persisted with it. So and I think that was an example of, and you drill down into why they persisted with it, and it was almost as though we told the markets we were going to do this, so we had to proceed with it. But that is not the way monetary policy should work. It should be much more flexible than that, much more adaptable. And that was that I think was a big mistake. So I think QT should go ahead. I think there is scope for, the question is how much you do, whether it's 10, 20 billion a month, or 10 to 20 billion a quarter, or more than that. I think Anne would like it to be more aggressive than that. I think the issue I would have, and the interesting one, is on interest rates. Anne was suggesting, go big, go hard on raising rates. Maybe that all those 50 basis point increases will take you up to 6%. Now, 6% or anything approaching that would be for the UK real economy would be a horror story at the moment, because people just aren't prepared for that. For rightly or wrongly, people have got used to a life, a time in which official interest rates are less than 1%, and that has been the case since early 2009. Suddenly going up to the kind of rate that we had between the early 90s and the financial crisis, when back rate averaged 5%, would be a profound shock for the economy, I think. So you have to be a bit careful about how aggressive you go from here. But I think I would support further tightening, both through QT and through interest rate rises. But I think it's important to acknowledge the how sensitive the real economy might be to going much more aggressively than that. So further tightening, but do it with an awareness of how the economy has changed over the past 12 years or so.
Okay, great. I think that this question of quantitative tightening, so it's a little bit of a technical question, so maybe we don't want to dwell on it too much, but I suppose I wanted to ask Anne, actually, for her view on this. How effective quantitative tightening would be as a means of monetary control versus, say, increases in interest rates? I suppose the traditional understanding was that quantitative easing or tightening would affect banks' capacity to lend because they were reserve constrained, and QE and QT affected that sort of reserve level. In fact, reserves are so abundant and have been since shortly after the financial crisis that doesn't really seem to hold. So the simple question, how effective do you think QT could be, and how? How would it work? Oh, mute again, Anne.
At such low interest rates, I think you're correct that it's not going to have a particular effect. But I don't think that should be, the fund should be sitting around in bank reserves when interest rates start to go up. I think I'm trying to draw a parallel here between what is going on now and what happened in the early 1980s, where we did let inflation get out of control. And I'm thinking back in my experience in the US, at that point, the only thing to do was to raise policy rates until you drove the economy into a recession. And we're getting toward that here. And there's no nice way to bring inflation down. The more you let inflationary expectations become entrenched, the bigger the recession you have to drive the economy into in order to bring inflation down. And I would rather get it over with.
Yeah, yeah. Rip the Band-Aid off quickly, as they would say.
Well,
over here.
Before people are expecting high inflation to persist, and this gets built into wage contracts and credit contracts.
Okay, cool. Well, one last question from me, and maybe put this briefly to everybody, perhaps a slightly provocative question, but the CPS was at its inception sort of fundamentally a monetarist think tank. And I know traditional monetarism has been out of fashion for a while now, but I do note that Ting Congdon's group at the University of Buckingham sort of called the current inflation pretty accurately. And I think I've seen stuff from them that if you map M4X, measure of the money supply, with a lag onto the current path of inflation, it's a very, very good fit. And I obviously can't draw, pure conclusions from that. But I think what's interesting from one of their recent research notes was that the rate of monetary growth had already plummeted from the heights it reached last year, and indeed appeared to be below the sort of long run rates in the decades up to the pandemic. So does that give any of you pause for thought if you think about monetary policy in quantity terms at all? Does that give you pause about monetary tightening? Is there a possibility that actually the tightening has already happened and these things happen on a lag, so we won't see it until next year? Or I suppose, Anne, is that the kind of magical thinking that you referred to? Maybe if we just run along, Gerald, do you want to take that one first?
The Bank of England should have tightened last year. It should have raised rates. It should have stopped quantitative easing and indeed reversed quantitative easing through quantitative tightening. If I was on the committee last week, I would not have voted to tighten. I think there needs to be a pause. And I think you're right in terms of your question, and it comes back to something David mentioned in his opening comments. When the Bank of England looks at its assessment of the economy, David referred to its focus on output gaps, and he talked about it in terms of a closed economy. They also look at inflation expectations. What is quite remarkable is that they don't ever mention the word money in their quarterly monetary policy report. I remember writing an article actually in the Daily Telegraph about this back in 2017, after reading about 2 or 3 successive quarterly inflation reports, as it was called then, and thought, don't they ever mention the word money? One does not have to be a monetarist to recognize that on your dashboard of the economy, you should be looking at monetary variables. And it's crazy that we do not have this more center stage in our central bank's focus on the economy. And I think what Tim Congdon has said and what you alluded to in your question is quite accurate. Now, also at the same time, coming back to your previous question, because I think it's relevant here, when one looks at policy actions now, it's not only the relationship between rates and QT, but therefore the yield curve. But also it's the wider issue, the other committees at the bank on financial stability and prudential regulation. Banks are effectively incentivized to lend to the property sector and to buy government debt. We need to have more lending to the real economy. These are issues that never, in my mind, figure promptly enough in the debate. But all of these are relevant. To conclude my answer, when one looks at the actions now at the bank, one needs to look at them alongside fiscal policy. And also, no one ever mentions the currency. We don't have a currency policy. But the financial markets are looking at the UK and thinking, look, globally, apart from China, maybe one or two other countries, most economies are seeing tighter monetary policy. But Britain at the moment is the only country really tightening fiscal policy, maybe too much relative to the economic cycle. And if monetary and fiscal policy are both tightened simultaneously, the markets will look for a shock absorber, which is the currency being pushed weaker. So I think one needs to, coming back to something, again, David talked about the need for flexibility and adaptability. We shouldn't be on autopilot. My fear is the Bank of England seems to think it should now be on autopilot, and clearly we need to avoid that.
David, briefly, do you think anyone at the Bank of England is thinking about money supply, or is that just too old-fashioned for them?
No, you make a very good point, Tom, about that. And the growth in annual growth in M4X got up to about 16% when QE was in full swing. It's come down now, and the annualized rate is actually very low, as Tim and his colleagues have pointed out. It's very curious, and I was going to make the point that Gerard just made about the omission of money in any discussion in the monetary policy report, which is very, very curious. And it used to be different, even in the independence era. I can remember people at the bank back in the run-up to the crisis, reassuring me that at that time we had strong growth in M4 leading up to the crisis, and they said, don't worry, it's not going to be inflationary because it's all off balance sheet and it's all off balance sheet lending. And of course, the problem was then that they were looking at the money supply for the wrong reason. The off balance sheet stuff was the dangerous stuff, which actually gave us the crisis. And the bank, I think, dodged a bullet in the financial crisis in the sense that it wasn't responsible for banking supervision then, having had it taken away in 97 and getting it back after the financial crisis. I think we might have a very different view of the Bank of England and the independence era had it got its current range of responsibilities that it has now back in the run up to the financial crisis. But yes, I mean, what the slowdown in the money supply is, and Anne will disagree with this, but it's one of the reasons why I think what they sometimes in the financial markets call, the immaculate disinflation argument. Why should inflation come back down again? Why do central banks always think inflation is going to come back to target? Well, at the moment, we've got the slowdown in the money supply, which is important, I think. We've got the fact that, however uncomfortable and however further it may have to go, this energy price spike, they tend to be short-lived. We don't have a wage price spiral in the UK. Average earnings growth is about 4%. Average earnings plus bonuses, regular pay is about 4%. Include bonuses is about 5%. Settlements are about 3.5% on average. So we are seeing some wage pressure, but it's quite limited. And this is certainly not the situation we had in the 70s and the early 80s. So those are reasons why I think inflation will come back down. The one that troubles me most, and Gerard will know a lot about this, being a China expert, is what's happening in China at the moment. And, the supply chain difficulties that marked the economic start of the pandemic, in China seem to have revived in quite a big way. So I think those look to be more long-standing, long-lasting than we would have hoped. But for other reasons, I think it's reasonable to think inflation will come back down. But and the money supply is one of those.
We're going to go to questions, but Anne, David said you would disagree. So now's your chance.
Well, I wanted to get back to this measures of money argument. I think it was Milton Friedman who said that inflation is always and everywhere a monetary phenomenon. And if you look at things over a long enough period, there'll be a very good relationship between various measures of money and inflation. But in the short run, where the relationship between inflation and measures of money isn't very stable, and economists haven't been very good at extracting information from various measures of money. So there were good reasons that central banks gave up using various measures of money as intermediate targets.
Okay. Thank you. So, okay, questions from the audience now. And I will just note for those of you watching at home, confusingly, Zoom has both a chat function and a Q&A function. If you could put your questions in the Q&A bit, that would be helpful, just so I'm not looking at two different places. But those who've already used the chat function, don't worry. I have seen your questions. So I'm going to try and group some of these questions together thematically. There are two big things, I think, that emerge from the questions that people have asked. One is about asset prices and whether monetary policy should be made with asset prices in mind somehow. Now, whether this is financial assets, whether it's housing. I think it was you, Gerard, that you said that one of the cardinal sins of the Bank of England was that their monetary policy had sort of pumped up asset markets even while measured inflation remained low. So that's one of the questions. The other question that's come up a lot, and I think is very interesting, is about the connection between monetary and fiscal policy. First of all, is that our governments who are running, huge deficits that are largely being funded by the central banks, albeit perhaps indirectly, is that compromising central bank independence? Similarly, I suppose there's an argument over here that part of the reason for Britain's internationally quite unusual fiscal tightening post-pandemic is, I think, a fear in the Treasury that because of QE, the government debt is actually quite sensitive to rising interest rates, and they would rather avoid that if they can. And so if they can sort of suppress demand through fiscal policy, that's kind of preferable to doing it through monetary means. So a couple of big questions there, and I think maybe I'll give you each the chance just to think about those broadly. Asset prices and how you reflect them in monetary policy, and also this tricky question of the connection between fiscal policy and monetary policy, particularly with the kind of balance sheet positions that most governments around the world have got themselves into. And yeah, I should obviously pick one of you to go. So Gerard, why don't you go first?
Okay, thank you. In terms of the first point, asset price inflation, yes. I think in qualitative terms, it should be important, but in quantitative terms, it's hard to say that the bank or indeed any central bank should have a target for asset price inflation. What does that mean? Basically, clearly, they should have it on their radar screen. They should be conscious of it. The challenge about having a 2% inflation target, and we saw this actually, to be frank, even before the 2008 global financial crisis, because the actual inflation rate was low. And indeed, Neil Collins then at the Telegraph called it the China price index, not the consumer price index, because the global impact. Because that was low, the Bank of England claimed or said, look, we're doing our job. But asset price inflation was already rampant before 2008. So yes, it should be taken into account. And indeed, it's part of my reasoning for thinking that we need to change the inflation target to a money GDP target. To take into account wider economic considerations, not only asset price inflation, but overall economic growth as well as inflation itself. In terms of monetary and fiscal policy, the challenge always about making a central bank independent is that you might lose consistency between monetary and fiscal policy. But I think the heart of the issue here is the role of the Treasury in the United Kingdom and the way the Treasury is too powerful in all aspects of economic policy making. But maybe the way to look at it, not just in the UK, but in Western economies, the big story in the last 20 years has been both the shift in the balance of economic power towards China and emerging economies and the digital and data revolution. Now, some countries in the West or some parts of the West have responded by addressing structural change. Silicon Valley has positioned itself at the center of the digital data revolution. Ireland has become the highest income country in Western Europe by focusing on education. Other countries, including the UK have taken the easy way out. We've gone for the cheap money route, and the cheap money route has, as we've seen recently, also allowed fiscal policy to become more relaxed. But the Treasury probably over worries. The maturity of UK debt is still quite long. Could have become longer. We could have borrowed more longer term last year when rates were at record low levels. Naturally, the QE itself has made some of that more shorter term and the sensitivity you talk about. But I think we shouldn't over focus on that. And maybe the ideal mix people might argue for as we move in future years would be a more relaxed fiscal stance and a tougher monetary stance. But as I alluded to earlier, one needs to take account of the economic cycle and not go on autopilot for both of those.
Anne, how about you?
I have a different view about the asset prices. If you abstract from risk considerations, the price of a share of stock ought to be the discounted present value of its stream of dividends. And the price of a house ought to be the discounted present value of what you could get in rent for it. So if real interest rates start to go towards zero, what do you think happens to these discounted present values? So that alone explains why asset prices go up without any reference to monetary policy whatsoever. And if monetary policymakers keep inflation stable, then aside from what happens to the real interest rate, that should help stabilize asset prices. Central banks might want to consider asset prices in that potentially they contain information about future inflation, although I'm not sure that there's terribly much inflation to be gained. And if they dislike the level of asset prices, I think that's a matter for regulators, not central banks.
Okay. And David?
Yeah, Gerard and Anne make very good points. I mean, I think on, there is obviously an argument about QE feeding into asset price inflation, which the bank has conceded. But I think the more general point, picking up on what Anne was saying, you look at, everybody believes UK house prices are too high. Is that to do with structural issues, concerning planning, or is it to do with monetary policy? It's partly to do with monetary policy in the sense that, the kind of affordability measures we used to look at for housing were the house price earnings ratio. But these days, affordability can be measured, by, what proportion of income is our monthly mortgage payments for first-time buyers, etc. And if you're in a kind of what has seemed like a permanently low interest regime and mortgage rates are low, fixed rate mortgages are low, then high asset prices themselves, are not quite the issue they were in, what some of us might regard as a more normal interest rate regime where you've got positive real official interest rates. So I think monetary policy has affected that. I mean, on Gerard's point about inflation, one of the features of the past 25 years until now has been that the UK has tended to have, much higher service sector inflation than goods price inflation. So typically 3 or 4% service sector inflation, 0 or near zero goods price inflation, and the two averaging out something like the 2% target. At the moment, obviously, things are very different. You've got goods price inflation, which is higher than service sector inflation, hence the problem. And the thing that I suppose the bank would hope to bear down on most is just to prevent that service sector inflation getting out of hand and assuming that goods price inflation will come back down again. On the other point, which I think is a very interesting one about the blurring of the lines and the compromising of bank independence, I think it's been closer to being compromised during the last 2 years than at any time in the post-independence era. That I worked out the other day that if you exclude how much government debt would have gone up anyway as a result of pre-pandemic policy, then the pandemic added about 450 billion so far to UK government debt. And 450 billion is exactly the QE response to the pandemic. And, Andrew Bailey, the governor, almost admitted that, we did the first tranche of QE to to help the government out, to make it possible for them to fund debt in very difficult circumstances when the pandemic broke. So I think the lines have been blurred. I don't detect, I talk to Bank of England people, I don't detect that when they are contemplating raising rates, and we've talked about the greater sensitivity of short-term rates to debt, the debt interest bill as a result of QE. I don't detect that is a constraint on them. I don't detect that they think the Treasury is looking over their shoulder, either at what's happening to short-term rates or the effects of what they are doing in terms of bond yields and the wider debt interest bill. So I think they've retained an independent frame of mind, but of course we can only judge them by their actions, and we'll see some of those actions in the coming months. But as I say, I don't detect that they think the Treasury is constantly looking over their shoulder on that.
So maybe a bigger long-term question, because we talked a lot about interest rates and at times normalizing interest rates and so on. I suppose it's a question about what is normal or what will appear normal in the future. There's an assumption, I think, among a lot of people that interest rates will go back to where they were pre-financial crisis, that was normal. But then, of course, other people argue that central banks have been followers rather than leaders, and that lower interest rates are a long-term secular phenomenon that we will live with and adjust to. Anne, can I ask what your view on that question is? I suppose it connects with your answer on asset prices as well, that what looks normal there depends very much on real interest rates and what their natural level would be.
Well, real interest rates are a structural feature of the economy. They're determined by such things as demographics. And I'm guessing that real interest rates are going to be very low for a long time. I don't think economists have a wonderful explanation for real interest rates, but this is something outside of what a central bank can influence, or should try. They shouldn't try to influence.
Okay, great, thank you. And Gerard?
Yeah, I think this is where we need a fundamental reassessment. I disagree with Anne's answer, even though theoretically it's right. Oliver Blanchard wrote a paper earlier this year for the Peterson Institute on this topic, saying effectively R-star neutral interest rates should be close to zero. And this is the difference between theory and reality. In reality, having real interest rates and nominal interest rates close to zero has, as we've seen in the UK and as we've seen in many countries, and as we've alluded to earlier, lots of negative consequences: asset price inflation, financial instability, and also preventing inflation from picking up. Anne touched on earlier about the painful consequences of when you try and cap inflation, and David touched about positive real interest rates. Now, the only country probably at the moment in major economies, Brazil, last week, they hiked for the 10th successive month. They have positive real interest rates. Interest rates are above the rate of inflation. In most other countries in the West, interest rates are lower than the rate of inflation. So we have negative real interest rates. And in normal times, we should have positive real interest rates. But to actually get inflation down, if you really push rates up, as we saw in the 70s, you really cripple an economy. You cause a major recession. That's a challenge. Your question is longer term. I think we should reassess the remit of the Bank of England. I think we should have a nominal target for GDP, or the target for nominal GDP of 4 to 5%. Inflation maybe 2 to 3% ideally, but in reality, probably we're going to have inflation nearer 3 to 4%. But if we say 3%, economic growth rate is far too low. That needs to get up to 2%. But in answer to your question, R-star, neutral level of rates in the future, I think should be nearer 4%. And that would imply being above the rate of inflation if inflation settles down above the current target of 2%, but nearer 3%. So too many numbers bombarded around there. But in a nutshell, R-star neutral interest rates in the future should be around 4% in the UK, and we should have a target for nominal GDP of around 4%, maybe 4 to 5% if we really want to stretch it. That would allow us to have both low inflation, bound on inflation, allow the economy to grow, and be consistent with reducing the ratio of debt to GDP as we saw in the post-war period in the UK.
David, do you have a view on this question?
Yeah, I do. Yeah, I mean, one of the, I have a family connection with some of the interesting research that was done on this at the bank on the secular drivers of low long-term interest rates, and they include, of course, the global savings glut, globalization, and so on. And the interesting question at the moment is whether some of those forces are going into reverse, particularly globalization. But I think just to be very simple and straightforward about this, if you go back to to March 2009, when QE was launched and interest rates, bank rate was reduced to 0.5%, a level to which it had never been cut before. The historic norm, bank rate had never been below 2% until the financial crisis. And you think back to that time, and every member of the then MPC, which had made that decision to cut rates to 0.5%, expected that this was very much a temporary emergency move, and that within a year or 18 months, rates would be up again, not up to pre-crisis 5%, but probably up to 2%, 2.5%, 3%. And I do not think that would have ushered in, if that had happened, I do not think that would have ushered in a period of deflation or seriously below target inflation. I don't think it would have done any damage to the post-crisis recovery. I think it would have just been accepted as a kind of a return to something more normal after an economic emergency. And because that wasn't done, I think we got locked into these, very, very low, near zero official interest rates, and not just in the UK. And I think that has been where the harm is, and that is why even raising rates to 1%, which Gerard said he wouldn't have done that. Even raising rates to 1% looks quite dramatic in the context of doing virtually nothing for the previous 10 years or so. So I think the mistake was not to move out of the emergency quickly enough, because as I say, I don't think any great harm would have been done. People would have quickly got used to the idea of 2 or 3% bank rate being the norm. There would have been room to cut, when the next crisis came along, and so on. There would have never have needed to be a discussion about putting negative rates into the toolbox. So I think that was when the biggest mistakes were made. Just after the halfway mark of independence. That's when a lot of the mistakes were made.
Yeah, I agree.
Well, one final question. We're very short on time, but I want to, and actually, I think Gerard might already have answered this one, so maybe it's one for Anne and David. Although I'll give Gerard a chance to have a final word, of course. Thinking about the Bank of England and its 25 years of independence, of course, independence isn't and was never intended to be an absolute. They're bound by framework, rules, political accountability, and so on. So if we assume that the Bank of England remains independent, I don't think there's any real question of that. How should its remit or the rules surrounding it change? So we've talked about a nominal GDP target, for example. David, Anne, maybe Anne, you first. How would you sort of sharpen up the role of the Bank of England going forward?
The problem with the Bank of England Act was it was written as a response to bad monetary policy in the 1970s and 1980s. And so it functioned well in a period where the problem was inflation rather than financial stability. But it wasn't written to deal with financial stability. And I think what you want is the central bank has to be the supervisor and regulator of the financial institutions because it is the lender of last resort. And so we have an institution then that has this quasi-fiscal or actual fiscal role, and such an institution cannot be entirely operationally independent, and it has to be held to higher standards of accountability than the Bank of England Act gives the MPC. So I would be more precise about separating out the MPC from the rest of the Bank of England and giving the MPC operational independence, and indeed more operational independence than it already has, I would remove some of the ability of the chancellor to meddle with choosing the rate, the measure of inflation, and particularly the Special Powers Act, where he can intervene when the economy is in bad shape. I think that's really where you don't want the chancellor to be able to intervene. But then the rest of the Bank of England, the part that does more than set policy rates and maybe choose the size of the balance sheet, that part does need to have a lot more formal accountability because it's playing with taxpayers' money.
Sure. And thank you. That's a really fascinating answer and an interesting prospect as well. David.
Yeah, I agree with a lot of that. I mean, it's operational independence rather than complete independence. It's also, as Gerard and Anne discussed, it's not independence when it comes to the choice of personnel, including the governor, members of the MPC, and so on. So it's a constrained kind of independence. I would like to see, as I've said, a lot more debate from the bank. I'd like to see them moving into better and clearer communications. I mean, bank speak is speaking in tongues, really. You have to sort of read between the lines. It's the worst kind of bureaucratic language that that you see from part of the civil service, but also from the Bank of England. And it is not because what they're doing is excessively technical. It doesn't need to be, but you have to. It's all nods, winks, and sometimes those nods and winks are unreliable. I think they need to communicate better. They need to communicate more clearly. They need to tell us what they're up to, and to do that in a way that would, help public confidence rather than, I think at the moment, diminish it.
David, thank you. Gerard, time for a quick final thought for you. I know that there were rumours you were in the running for the governor job last time around. Had things gone differently, would we be targeting nominal GDP already?
I think we should be reassessing the target, as I've said earlier, and nominal GDP, I think, is an important possible future target. Over and above what we've all talked about, rather than repeating what's been said, I think diversity of thought is really key here. The bank needs to really be held to account, and communication is part of that. We don't have effective communication at the moment, and we touched on that. We don't have enough scrutiny. But when one looks at it, the court of the Bank of England, I know they're trying to recruit 4 people at the moment, but the court of the Bank of England, which looks at the governance, doesn't seem to be fit for purpose. And we need to really have a diversity of thought in terms of the membership of the committee, the Monetary Policy Committee. But it's not just the Monetary Policy Committee. Microprudential policy, macroprudential policy, and monetary policy all need together. I don't think the monetary policy should be separated, as Anne said, but diversity of thought with diversity of background needs to be more centre stage in terms of choosing future members of the various committees.
All right, Gerard, thank you. And thank you to all of our panelists. If we were live in the room, I'd ask for a big round of applause, but it would just be me clapping in this case. But never mind, it's been absolutely fantastic. What a fascinating discussion. I hope those of you watching at home or in your office have enjoyed it and found it stimulating. Hopefully we'll have further such discussions in future. So yeah, do sign up to CPS newsletter, keep a lookout for future events, and I'll hope to see you all soon. Thank you all, and please enjoy the rest of your day.